But I'd just like to say thank you for coming to this session tonight. I was informed that it's one of the least popular, but I think it's going to be really interesting. But to start with, I guess, if you think about impact investing in public markets, I think everyone automatically thinks of green bonds. So I think we're going to elaborate a bit more on that tonight, expand it to green bonds, social bonds, and sustainability bonds. So in the world of acronyms, GSS bonds. We'll use that probably going forwards as well. So I'm really happy to welcome three panelists tonight. I start with Maria Minucci, who's from M&G. She's a fund manager at M&G, and she manages several sustainable multi-asset funds. We also have Nathaniel Levy from HSBC, who is on the underwriting side. He's a investment banking associate specializing in sustainable bonds. And then at the other end of the table is my colleague Pietro Sett, who's a research associate at Main Street Partners. And Pietro is our sort of in-house green bond specialist. So you'll be hearing from three different aspects on the market, and it should be a really interesting discussion, hopefully. So I think to start with, I think I'll ask Pietro to give some basics on the market and the instruments that we're going to be talking about, and we'll go from there.
Sure. Thank you. Actually, people might be asking why we're here. Just 12 people here, maybe other 12 on the call, talking about the debt markets and impact investing. And actually, the plain answer is because everyone's talking about it. We have seen in the green, social, and sustainability bonds market 50% growth every year for the last 5 years on average. So as you can see in the chart on the slides that we're bringing up here, the market was really negligible in the big order of things 5 years ago. While now we're talking about at least 2 trillion of green, social, and sustainability bonds out there. That's as much as the Italian GDP for 2021, which I assure you is quite a lot. Another big number which should ring a bell is the fact that 29% of European investment grade corporate issuance last year was from corporate bond issuers was green, social, or sustainability bonds. So that's massive. It's €1 every 3 euros last year was for this type of issuer was labeled as green, social, or sustainability bond. So it's very big. Going to your question, actually, what is green, social, and sustainability bond? It's a simple bond. It's like any other traditional bond, just that there is this major component of the use of proceeds, which enables investors to understand where the money is actually going to be spent. So we're talking about debt financing going through specific projects which are disclosed before the bond is issued. So that's a massive game changer in terms of transparency. And it's the main reason why this market is in such a hype, if I could say, but it's there to stay because regulation is on our side.
Thank you very much. And Nathaniel, can you give us your perspective on the market and what you've seen over the last couple of years, especially in the pandemic?
Yeah, thank you. So I think obviously the pandemic disrupted the market every time, but we saw some interesting trends in this GSS bond market, which was the surge of social and sustainability bonds, because before most of those GSS bonds issued were in green format. And what happened is that during the pandemic, there was massive financial needs from all types of institutions, public or private. And everyone realized that all those financial needs needed to go towards sort of social projects per se, such as support for SMEs in difficulty, of financing the healthcare system. So we saw a lot of social and sustainability bonds issued, and I think that a lot of issuers realized that ESG would be a sort of key differentiator. So we had some public agencies that are social per se, but that hadn't issued in social format. And I'm thinking about the EU with the SURE program, but also some French public agencies such as CADES or UNEDIC, who decided to label all their financing program in social format, and that's something I think that convinced all the investors, and that was a good differentiator in order to be more accountable for the social impact that those organizations provide. And maybe the other trend during the pandemic was some corporates who continued or started to issue some green bond, and I think it was a bit outstanding, because the message for the market was that in spite of all the social disruption, the pandemic, etc., they are still committed to a climate agenda, and a lot of corporates had very strong demands from the investors for being committed to that.
Perfect. Thank you very much. And coming on to Maria, I suppose you come from the multi-asset world of things, so you've got a different perspective, but what do you look for when you're looking at investing in GSS bonds?
Yeah, so we manage a number of multi-asset sustainable funds, and as part of multi-asset, we seek to invest in different asset classes that have different risk and reward characteristics. And from an ESG and sustainability standpoint, historically, there's been a lot more focus within the equity market that has been within the fixed income, but fixed income remains a key area for us to be able to build well-diversified multi-asset portfolios. And the evolutions that have been described just now on this market really opened up opportunities for investors like us to be able to construct portfolios that are well-diversified, but that they maintain some very strong characteristics from an ESG and sustainability standpoint. Now, what we have seen is a strong increase in terms of liquidity, volumes, availability, type of issuers as well. So there's a lot more diversification in that respect, and innovation, as we've seen, from green bonds to social bonds, sustainability bond, and the most recent sustainability-linked bonds. Now, with this, the complexity has also increased, and from an investment standpoint, remain extremely crucial to do a very strong due diligence on these bonds to be able to actually understand what are the key ambition of the emitter in terms of the issuer, in terms of, for example, reducing carbon emissions over time or their own ESG agenda, and also to try and understand how the bond is actually structured and all the different characteristics in terms of governance, both from an internal and external standpoint, and how can we actually measure and observe that these bonds have delivered according to their ESG and sustainability characteristics. So an immense opportunities, but a lot of work for us investors to be able to truly identify what are the right bonds to add to our portfolio.
Cool. And I suppose coming back to Pietro on that, I think one of the things that Main Street does is we provide ESG ratings, and one area is obviously green bonds. So do you want to just give a bit more background into what you look for in a green bond or GSS bond?
Sure. Yeah, I'd like to start by saying that ESG ratings have been really important in the last years, especially in investment management, because they are one of the major tools that can, put data to more qualitative considerations in the ESG spectrum. So it's really about, putting numbers into, situations, into considerations that you believe are particularly important for your mandate. And when we think about green, social, and sustainability bonds, there is usually no different consideration than for a normal bond. But at Main Street, we do it a little bit differently, because we've been there for more than 10 years talking about these instruments. So we definitely know quite a lot about them. And we have grown to consider and to understand what to consider a good or a bad practice. And in doing that, basically, we have been establishing a methodology that basically is looking at what Maria was saying. So the governance of the bond, So what is this issue bringing on the table before the bond is issued? What documents am I looking at? Even like, what is the date of this document? Is it like from 10 years ago and I'm looking at some completely out of date thing, or is it very recent and it came out hot from a roadshow with very good interactions? So we're trying to get all of that into a simple number, because that's what investment managers find easy to use, and it's really the summary of a lot of other considerations. The other main component of this rating is, of course, the quality of the projects that are being financed. So that is something, but it's not just what we're looking at. So you might be looking at clean transportation, for example. So I would be considering differently if the issuer is financing an electric vehicle or just a mild hybrid car that we've seen quite a lot. Even my mother bought one recently, and I said, "Mom, no, Mom, that's not a hybrid car. That's just a normal car with some sort of thingy that makes it go down in CO2 by a couple points." So we're doing a lot of research and trying to keep update, but there's a lot going on, luckily.
And Nathaniel, I suppose from the underwriting side of things, what role do you play in sort of helping issuers sort of format what they're going to do from an ESG perspective? And what precisely is your role in that process, I suppose? And do you see a different role depending on what type of issuer it is as well?
Yeah, so actually, I would say maybe one of the key missions, but that we don't really talk about, is that we usually connect the treasury teams with the sustainability teams for the issuer, and most of the time they don't know each other before structuring the bond. So it's quite nice to see this connection being built. But our role as underwriter is to make sure that the issuers will bring sufficient transparency and quality to the investors when they come to the market. So it means helping them writing a framework, so green, social, sustainability, or sustainability-linked bond framework that will align with key market standards such as the ICMA pillars or the Climate Bond Initiative standards, and whose content and eligibility criteria will be broadly accepted and aligned with some taxonomies. And I know that we will come to this point a bit later, but the goal is really to make sure that they come to the market with transparency, with the ability to talk about the project that they will finance, and also with commitments strong enough to report and to track the impact of all the projects that will be financed. So there's also a part where we help issuers select the right project that will be financed with the ESG bonds. And maybe some differences. What is interesting that we work with all type of issuers, so governments, but also banks or corporates across different geographies. And sometimes when we work, for instance, with European issuers where the sustainability regulatory framework is already very strong, for instance, in Western Europe, where all the issuers are already obliged to make a lot of sustainability disclosures. It will be only a way of formalizing what they already have and to highlight what will make a real impact through their bond financing. Whereas when we work with other geographies, for instance, in the Middle East, where this sustainability regulatory framework is not as developed, we will work more on articulating, helping the issuer to articulate their sustainability strategy and demonstrate what they already aim to achieve to the market.
And then I suppose Maria.
I was just going to ask a question, because we're talking about impact investing, and I guess in my mind, I always thought of, got to have additionality to call something impact. So how do we, GSS bonds, I don't think all of them could really prove additionality in their impact. I think it's probably easier with use of proceeds, but especially sustainability linked bonds, it's kind of hard to prove additionality, or am I getting something wrong? Like, how do you think about it?
I think it's a very fair challenge, and I will agree with the point that, when you're looking at use of proceeds type of bonds, you can clearly see what you're going to finance, and you can clearly see if those activities are aligned with impact. And it's much easier to be able to address the materiality of what you're trying to invest in through the use of proceeds of those bonds. Now, the element of additionality for me has always been a very interesting one. But when a company think about how to use its debt, this is not static. So there will be a number of projects that comes and go. And what we've seen historically is when you have difficult times, if a company needs to reallocate its capital, very often it will be those projects that we will consider as being sustainable. And the fact that you have a use of proceeds bonds kind of ensure that those type of proceeds are still used for these projects that are so important. So this to me is an important element when we think about use of proceeds bonds that help identifying the impact that those bonds bring. For what concerns what you mentioned around sustainability linked bonds, then there your use of proceeds is not as defined, right? You're generic. So it's not as easy as saying all sustainability linked bonds are impactful. I think it's very important to understand what are the ambitions of the companies from a sustainability standpoint. Is the company actually driving some change within its operations, within its supply chains, etc.? And then another very important point is when the issuer defines KPIs that they aim to achieve, we have to be very careful on how ambitious those KPIs are, because sometimes, they're actually not very ambitious and the company would have get there anyway. So there's no really great advantage. So at least within our strategy, we make a big distinction between those bonds that are use of proceeds and the ones that are generic and have sustainability linked. So sustainability linked bonds, we don't consider them as part of those impact aligned part of the portfolio.
What do you call impact? Like, is it the traditional definition as per the Impact Investing Institute, where you have to have intention, it has to be measurable, and it has to have additionality? Because arguably any public instrument, somebody would buy it. So if we weren't financing, someone else would be financing it. So, and I guess on one interpretation, there goes additionality.
Yeah, I think, you as always, you do have a spectrum within positive impact of where you are. And we aim to focus on all the elements that you mentioned. So from intentionality to materiality to additionality. But there is a recognition that sometimes, from an investment, you might get more additionality than from another. And it's not often very easy to quantify, but it is something that we try to assess when we analyze those investments, being equities or being fixed income. Then I think it's also down to, the end client, what is their expectations in terms of, the level of impact that it's trying to achieve. And there is a thought, I think, in the market that private debt is more impactful than public debt. And there is, it's down to the gradient of positive impact. I don't think you have, every positive impact is different. And this comes down also on how you measure it. Can you really put in the same scale CO2 saved and, number of beds you're providing for homeless people? It's, it's a scale. And I think very often it's also very personal. But I think those are still the parameters that we try to implement. So intentionality, materiality, and additionality.
Sorry, I don't need to be keep asking questions.
I was going to say, that was one of them. That was going to be my next question anyway. In terms of, that's the way the regulations go, particularly in the EU, and data disclosure is obviously a key aspect. And I think that potentially that is one of the key selling points about GSS bonds. You've got measurable KPIs, as Nathaniel was saying. He's got an important role when it comes to the issuers themselves, making sure they choose or they select the correct KPIs that they can actually prove that additionality. I think that's a key stage of the process. So,
I think it's interesting because we've also seen a huge improvement in the past 5 years, but there is still a lot of areas where improvement is still needed, especially on those new types like sustainability linked bonds. And again, the role of Nathaniel and the underwriter is crucial on this, to be able to find the right level, the right KPIs that can demonstrate and measure this impact.
And then, sorry, can I ask one more question?
Go for it.
And promise last one. And then, like, would you put them into just the sustainable portfolio? You said you're multi-asset, so would it be called sustainable? Would it be called ESG, or would you actually call it impact? And I guess you also have to say, which shade of green you are. Yeah.
So the portfolios that we run, they have different components. So they're not all positive impact and they're not all sustainable. But for green bonds, social bonds, and pandemic bonds or sustainability that have gone through our analysis, so it's not just bonds that are out there and they're called, or they call themselves green. The ones that have gone through our analysis, which is articulated on the intentionality, the type of investment, and the impact measurability, if they pass this analysis, then we will classify them as positive impact. And the reason why positive impact was chosen as a name for this part of the portfolio is that, as you said, you have different spectrum within impact, and positive impact is the way in which impact through public markets tends to be identified.
If I may add also on that point, I think the big elephant in the room might be the taxonomy regulation as well, because if you think about Article 9, then that is considered at the end of the spectrum in terms of, let's say, the most, let's say, technically environmentally friendly projects for the European
I think that's
based on the European Commission, based on European Parliament and Commission thoughts and
it's just as far as they thought they could go.
Exactly.
Yeah.
And it's also very interesting because it's a process, the one of the European Commission is one that changes in time. So every 5 years, this data will be like the stringency for what you consider green will be increased. So if something today is green, it might not be in 5 years. So that's back to your point that you have to be very diligent in the analysis and not just write off something and forget about it. But
I guess in my mind, I promise I shut up after this. Just in my mind, I always thought of impact investing as a subset of ESG and sustainability investing, like it is on that far spectrum where it's not enough just to buy a green bond, but you actually have to prove something extra, and that something extra is trickier in public instruments. So that's why I'm asking so many questions.
Maybe if I can just jump in on that. So I think that there's been quite a lot of progresses in terms of setting the standards to prove that those green bonds and instruments are really impactful. And I don't know if you had the chance to have a look at the impact reports published by all the green bond issuers, etc. And so you can really, when it's well made, of course, you can really make the link, and maybe Maya will comment further, between the investment that was put in the green bonds and the key environmental impacts deriving from the projects that were financed by the green bonds. So I think that, yeah.
No, I agree. I think it's where you have the reporting side that is so important. Reporting in terms of KPIs, but very often what we ask issuers is reporting that is quite detailed and really tells us about what are the operations that they financed, and do we believe that this is the best use that they could use proceeds about. So when they issue a bond, there is a number of different projects that they can invest into, and some we would consider more impactful than others. So it's also through engagement sometimes that we talk to the companies that issue those bonds and ask them, so why have you used the proceeds in these projects rather than with other ones? Could you try and think about ways you can use your proceeds for those areas that we feel are more impactful? And I think it's also through the dialogue that you really can improve the outcome from investing in GSS or sustainable bonds.
So we mentioned the EU taxonomy briefly, and I know Pietro has done some research about this in terms of sort of the alignment of green bonds and sustainability bonds to the EU taxonomy. I just wondered if you could share your thoughts on it.
Yeah, absolutely. It's an enormous task. I'll start by saying that. It's not easy to understand PDFs published by the European Commission, but I don't blame them. It's a different language than the one we talk. So it is hard, it has been hard, but the task we went through and are still going through, as I was saying, we'll be going through probably forever. We're basically taking every single bond in our database, think about more than 2,000 rows, and as a matrix, you would see every row of bonds, and then on the columns of this enormous document, you have the sectors the Commission identified as being potentially aligned. So you have sectors like solar energy, electricity generation with solar energy, or you have manufacturing of hydrogen, and so on. So that goes up to 100 different NACE categories. That's how they call them. NACE is the sector they chose. So basically what we do is try and give a number for that coordinate that puts together the row and the column, and say if that specific project we're talking about is aligned or not to the taxonomy. There is let's say a room for judgment today, just because a lot of the issuers don't really, I wouldn't say they don't know what they're doing, but it's just they are not accustomed to the taxonomy yet. So very often it's an analyst work. Like you have an analyst doing research on equities or bonds, you have an analyst in our Main Street doing research on taxonomy and trying to put a label to that. So closing on this point, I think some interesting numbers from our research. It has been drawn on more than 1,000 bonds today. And for green bonds, we have an alignment of the projects they're being invested in of around 50%. So if you think about a bond of 500 million, on average, if it's a green bond, 250 million of that, it's considered green by the latest taxonomy regulation. If you think about the climate mitigation pillar, which is the one we are more easily working around. Sustainability bonds drop because there's a lot of social proceeds like healthcare or education and so on, and these are not considered by a taxonomy today, and that goes down to 20% on average. And last but not least, renewable energy projects on average are 60% aligned, which means that renewable energy is the most easily digestible project if you look at it from the lens of the taxonomy today.
So just on the back of that, I suppose, in terms of increasing sort of data disclosure generally in the market, I just wondered your thoughts on that, Maria, in terms of it's got to be positive for the GSS bond market in total, but in terms of sort of the fund offering, I suppose, where do you see the market going in that perspective?
Yeah, so I think, again, with the spread that we've seen in terms of the type of issuers, the type of bonds, that opens more opportunities for fixed income investors to be able to run GSS type of funds, which historically has been a bit more difficult given the liquidity, given the concentration on the type of issuers. For example, if we look at green bond in particular, the investment grade part of the market makes up the majority of it. But with the growth of sustainability linked bonds, then we are seeing more high yield players come into the market. So that creates again an investable universe that is more differentiated and gives the opportunity for fixed income funds to be able to be launched more easily and be more available for investors. Again, you know, this is always to be taken by thinking as well at the added value that, you know, a stock picker will make by analyzing the different characteristics of the bonds that we discussed. From a multi-asset perspective, again, it opens quite a lot of opportunities to be able to add to the portfolio these type of bonds that pass our analysis. And they will have different characteristics in terms of risk reward. So again, being very valuable to create a diversified portfolio, because you start to go from a spectrum of investment grade issuer to high yields to supranationals, and more we're seeing sovereign as well being present in this spectrum. And one area that is looking quite interesting in terms of growth is the issuance that we're seeing from emerging market countries, which very often from an ESG and sustainability perspective, they are underlooked, which to my view is sometimes unfairly so, but they tend to rate quite badly from a governance perspective. But where you start having use of proceeds bonds from emerging market countries, then that becomes a much more palatable option for mainstream investors to be able to add to their portfolios. And we have seen some interesting developments in the past few years. Latin America has been one of the first areas that has, from an emerging market standpoint, really came to this market in big size. So Chile is a repeated issuer. They've issued green bonds in both local and hard currency. They've more recently issued social bonds. And in the last few months, we've seen Colombia also issuing a green bond. So this provides investors opportunity again to be exposed to those markets, but with the added value of knowing where the use of proceeds are going. And so this provides some immense opportunities for investors today, and I think at the same time, probably for issuers to continue to be present in this space and improve the type of issuance that we're seeing.
And Nathaniel, on the back of that, I'd be interested to know your HSBC viewpoint on in terms of why are those issuers, why Chile is now looking at doing sustainability linked bonds, and sort of what your experience has been in that area.
Yeah, so I think and maybe to your previous point, Maria, yeah, it's very crucial to be sure that the sustainability linked bonds are well structured with KPIs that are robust enough, etc. But look, I think so yeah, maybe for context, Chile was the first sovereign issuer who issued a sustainability linked bond a couple of weeks ago, and they linked their bond to the achievement of their GHG emission reduction targets, included GHG emission reduction targets included in the what we call the national determined contribution. And they have also an objective in terms of increase of renewable energy in the overall national energy mix. And I think it can be a quite powerful tool for those sovereign issuers, because the national determined contributions to the NDCs are voluntary commitments, and by issuing this sustainability linked bond, this issuer will be financially accountable for reaching those GHG emission reduction targets, because if they don't achieve the targets, they will pay a penalty to the investors. And to be honest, we are seeing that there are a lot of discussions with many sovereigns on structuring SLBs for them, and we are sure that Chile has really opened the door to many other issuers. And I think that there are a few categories of sovereigns when we look at SLBs. There is Chile, so Chile already proved to the market their sustainability credentials, because they issue green bonds, social bonds, and sustainability bonds in different currencies. And so they could really demonstrate to the market that they have some robust green and social projects that will contribute to achieve the UN SDGs. But by issuing SLBs, they are committing more to a sort of long-term outcome on climate, which is a particular hot topic for the investors. And there are also some other sovereign issuers who might not have the sufficient data yet to issue use of proceeds bonds, but who've made some commitments such as the NDCs, etc., and who wants to prove to the market that they are committed to those objectives. So SLB can be a powerful tool for that.
Can I ask a question on this? Okay.
Go for it. Yeah.
Thank you. Two specific questions. One, in the case of Chile and in general, corporate and sovereign issuers, do they get to borrow money more cheaply if they do this, or is it more expensive? And the second question, could you speak to specific penalties or tariffs that, in this case, Chile or other issuers would have to pay? How does that work?
Yeah, so in terms of the borrowing, it really depends on multiple factors, but sometimes we can observe what some people call a greenium, where they will benefit from the success of the bond and oversubscription, etc. So they will pay a bit cheaper for getting those type of instruments, but it's not true for all the issuers. It's not a general rule. And to your second question on the penalty, so the ICMA sustainability linked bond principles require that there is a material penalty that is paid if the target is not achieved. What we've seen on the market, the vast majority of the penalty is an increase on the coupon, on the annual coupon that is paid by the issuer. But there has been some issuers who chose other types of penalties. For instance, there was an airline which issued an SLB, and they committed to buy extra carbon offsets if they don't achieve the target.
And are you saying, thank you very much. If I can ask a follow-up. Okay. So this is great stuff. I'm just learning so much. Look at this. I'm just writing. It's fantastic. Thank you. So that I would describe that as a debt ratchet or penalty for unachieved. Are you seeing? I've seen in municipal markets in the United States going the other way, right? So actually debt ratchets for overperformance on KPIs or overperformance on environmental such. Are you seeing that in your markets?
So we haven't seen that on the public bond market yet, and then maybe then Maria can comment from a point of view. We saw that on the private placement market and on the sustainability linked loan market. It's very common that we have this sort of symmetrical step up, step down, depending on the achievement of the target or not. From our conversation with the investors on the public market, investors are not ready yet to buy SLBs with a potential step down for various reasons. And then
sorry, boss, you're not going to get any money.
Because it would add some complexity. In a nutshell, it would add some complexity to the product.
Thank you. Sorry, Chad.
I don't know if Maria had any.
Yeah, no, I think it's interesting how, again, the evolution sometimes, borrows from what happened in the loan market and then moves it onto the public market. But I think a lot of investors are still getting fully to term with sustainability linked bonds. First of all, with the fact that you have generic use of proceeds. Secondly, you have some clear KPIs, but then you actually get compensated more if those KPIs aren't achieved. So it adds some complexity on the way you think about how you contribute to sustainability. And I think the market is still very much in evolution in terms of how to best, bring those products into the market in a way that satisfies different clients' requirements. And I think we'll continue to see quite a lot of evolution on this. I wouldn't be surprised if we have the step down at some point, but that's not something that we see at the moment.
Okay. Thank you. Brilliant. Right,
I think there's a question here as
No,
well.
I don't have a question. It's only just about the time. Did we agree to 10?
Yeah, we probably got just, sorry, Chair, just a
5
few more
minutes.
minutes. That's
Yeah,
okay.
sorry.
So I don't know if there's any other questions for the panelists.
I wanted to ask, in terms of the coupons payments, are they smaller for sustainability-linked bonds compared to straight debt? So say, for example, for Chile, despite the fact that he wanted to issue a sustainability-linked bond, would they have considered, is it cheaper to issue just a straight debt rather than a sustainable-linked bond? Are there, I would imagine the coupons should be lower, but I'm not sure what the market looks like now.
Yeah. I mean, from what I can see, normally you have the same level of coupons at issuance across green, social, or generic bonds, but you have the existence of this greenium, so this premium that then the market's priced in, because there is still scarcity of these GSS type of bonds, and so there is more client demand, and that creates a small premium on the bond. Now, from an investor standpoint, one thing that has been observed is that because there is so much demand and scarcity of assets, they tend to behave better in volatile market environments, because clients that or investors that buy a debt with a sustainability angle to it, they're less likely to then ditch it when things become worse. I mean, it's not truth all the time, but this is what has been observed. I imagine they have done quite a lot of thinking when issuing sustainability-linked debt, because obviously that could then eventually cost them more. Maybe you have a bit more insight on that.
I actually maybe wanted to share. I read the research on that, so I want to share it. University of Zurich made a very interesting document, research on this topic, and they actually found out that in many instances, issuers of SLBs, sustainability bonds, found an SLB premium, which was larger than the money they would have to pay more in coupon if they missed the target. So we're talking about numbers that often are balancing each other, because on one end, there is such a high demand for these bonds that may be reducing the cost of issuing that debt by more than what you would pay if you fail the target. So right now, I would say probably that from the issuer perspective, the goal for the next years would be maybe to push these basis points, step up a little bit higher. On average, we're seeing 25 basis points as being the average, and that could be going upper, I think.
Can I repeat that so I understand it? Right?
Yeah.
So I can issue a piece of paper which says it's a normal bond, right? And I pay. I'm gonna make it up. I'll pay 2%, right? And I can issue you call it a sustainability-linked bond, and I can issue a sort of 1.75%. And worst case scenario, I just completely blow it. I don't do the KPIs, horrendous. I pay like 20 bips. And so net, I'm only paying 1.95 for my debt. Is that what you're trying to articulate?
Yes, and that would apply the coupon step up only for the remaining time of the bond.
Yeah.
Because of course the KPI is not for tomorrow, it's going to be for 3, 4, 5 years time from now.
Sure.
You have to check all these things, like how long is this bond? Is it just
point.
1 year after?
That's right. Yeah. But what you're saying is net is a no-brainer for a corporate issue.
Yeah, potentially.
Even if you're just interested in money. Okay, that's a seriously hard argument. Can I ask a question?
Last one.
Okay, last one. So you guys are in these markets, okay, and alluding to this lady's some of her questions, I think. So will you share with us, a couple of real stinkers, like people issue green bonds, you're like, that's not green, that I can't even go anywhere near it. And perhaps some others where you think, you know what, that's a fantastic example of an issuance where I'm really like the Chile one's probably a good example, but could you just share some, examples where you thought, you know, you kidding me? You're calling that a green bond? You're calling that social bond? Nowhere near social.
That's alluded to greenwashing, right?
Yeah.
Yeah.
So can you share some examples?
Maybe I can start. And as
I guess you talk about this all the time. I don't know.
Yeah. The only thing that, as I'm speaking on behalf of
Don't mention anything.
I won't mention any name, but I would say that
My client, doctor.
I would say that one of the most common areas for greenwashing is where there is a misalignment between the use of proceeds and the overall strategy of the issuer. So, for instance, if you have, like, let's say, an oil and gas company that issue a green bonds to finance 500 millions of capex directed towards solar panels, but that on the other hand, they are saying that they will invest 30 billions in the next 20 years in exploration and production of fossil fuel. This would be typically an example of greenwashing. But that's also the case for less extreme scenarios. For instance, when a company wants to differentiate itself by issuing a social bond, for instance, they might think that the market won't scrutinize them on their environmental credentials. That if they have a poor climate policy or environmental policy, this would be considered as well as social washing or greenwashing, in the sense that, okay, they just want the market to see the good parts of what they are doing and to avoid this. But I think that the market is now mature enough to realize what is greenwashing in those instances.
Yeah, maybe just a couple of examples on that. I think, in some cases we will find, this use of proceeds can also be backdated, so they can be allocated to things that actually have already been built or financed, or where the project is concluded. And that's not something that we see with favor, because we want to, that will be completely on the other direction of additionality. Is already there, so there's nothing else. But that happens as well, and it's not something that we'll consider. There's also been a situation of like disappointment where, I thought personally the structure was really interesting, and that within the issuer there was a lot of very interesting projects that could really add value. And that was particularly on a company that he's a paper pulp producer, and a lot of the proceeds were around, biodiversity and improving the sustainability of the way that they do things. And there was some very interesting project, and the company started really well. They had some great reporting on it. And then within 3 or 4 years after half of the use of proceeds were used, we started to see a real deterioration both in the reporting and also on how they were using the proceeds. And I guess, we work with engagement in these cases, but it's just very disappointing, like almost on a personal basis, because you can see how much better they could have done. And but yeah, so I think with experience as well, and seeing how the market evolves, investors are able to capture more and more what are the key elements to take into account.
Brilliant. Well, we are out of time, but I think we're safe to say we could probably go on talking about this for a few hours. So, no, brilliant. Thank you very much for your content.